Hi everyone, welcome to the next installment of Charts in Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for Verify. Today we're going to look at three of the US's major stock market indexes and discuss how they've changed since their peaks from 2000. In this video, I want to note that we're using data through May's close. So the S&P 500, the Dow, and the Nasdaq are all stock market indexes used to measure the performance of various aspects of the US stock market. The indexes generally rise and fall together. However, the extent of gains or losses produced by each can differ depending on market conditions and the state of the economy. The indexes differ from one another in several ways, such as weighting methods, coverage, and criteria for including stocks. For example, the S&P 500 assigns weightings based on market capitalization. It includes roughly the 500 largest U.S. stocks spanning 11 sectors and offers a more comprehensive view of the broad market's performance. The Nasdaq also employs market cap weighting, but includes over 3,000 stocks with a heavy focus on the technology sector, making it a popular benchmark for technology and growth companies. And lastly, the Dow is a much smaller index consisting of 30 well-established blue chip stocks with weightings based on stock prices, which makes it a more conservative and limited representation of the broader market. So now let's get to the charts. So real quick, I just want to start with this overview table. Each of the indexes reached a relative peak in 2000. However, they occurred on different days, as you can see in this table. The Dow on January 14th, the S&P 500 on March 24th, the Nasdaq on March 10th. So throughout this video, when I refer to each index, I'm going to use the start date as each individual index's respective 2000 peak. For example, the S&P 500 peaked on March 24th, 2000. Since then, it's grown almost 246% nominally, but just 87% when adjusted for inflation. Okay, so this first chart overlays the three indices using their nominal price, excluding dividends, starting in 2000. As you can see, the indexes have generally moved together, but for much of the 21st century, we saw that the Dow had the largest growth, followed by the S&P 500 and then the Nasdaq. However, all of that changed when the pandemic hit in 2020. And over the last few years, we've seen the Nasdaq and S&P grow and outperform the Dow, which should come as no surprise since each of these indexes have a higher weighting in tech and growth stocks, which have performed very, very well since the pandemic. All right, so now let's move to the next chart. It's going to be the same as this one, but this time we've adjusted it for inflation using the Consumer Price Index. The overall shape and direction of each index is very similar to the previous chart, but the biggest difference that you'll see is that the real growth in each index is significantly lower. We have a lot more red space on this chart than we did on the previous one here. We only started to see positive growth starting in the back half of the 2010s. So this one and the previous chart are based on price only, but what about dividends? Would the inclusion of dividends make such a significant difference? Well, let's examine the performance of three ETFs that are designed to track one of our three indices. So first, the SPY ETF is designed to track the S&P 500. What would the return on a $1,000 investment in the SPY ETF be if you had invested on March 24th, 2000? The total return certainly looks better 20 years later, climbing to just over 5,000. But the real inflation-adjusted purchasing power of that 1,000 is almost half of that, currently at 2,713. Also on this graph in the upper left-hand corner, you can see the difference between the nominal compounded annual rate of return versus the real inflation-adjusted rate. The nominal rate is 6.89%, while the real rate is much lower at 4.21%. Next, we have the DIA ETF, which is designed to track the performance of the Dow. So what would the return of a $1,000 investment in this ETF be if you had invested on January 14th, 2000? Again, the total return looks much better over 20 years later, just above $5,600. However, that real purchasing power is just under 3,000, currently at 2,997. And lastly, the QQQ ETF is designed to track the performance of the Nasdaq 100 index. Our last chart here looks at the return on a $1,000 investment in the QQQ ETF if you had invested on March 10th, 2000. After 24 years, your money has grown to just over $4,600. However, the real purchasing power of that 1,000 is significantly lower at 2,498. Well, that's all for our examination on these three indices and their changes since their 2000 peak. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.